Stocks slip ahead of India's Republic Day holiday in a truncated trading week. Financials and utilities lead the slide, even as metals and auto show some resilience.
TVS Motor results are in line, but an upbeat guidance surprises even as Pidilite and SBI Cards put up weak shows and Indus Towers hurts on a key client default.
United Spirits feels the pressure of costs on margins, lower revenues and a loss puncher quick heal, but Nazara Tech gains as growth momentum picks up.
Lenders to Reliance Capital move NCLAT against a stay on the auction plan, while lenders to Jet Airways move NCLAT to stop transfer of ownership in the airline to Jalan Calroc Consortium. Hello and welcome to Halftime Report. I'm Sonia Shenoy and with me is Mangalam Malu and Sonal Bhutra. Well, it is a disappointing start to trade for sure. And at noon, the market is at the lowest point of trade. The Nifty is down 220 points and the Sensex has lost 750 points. Now, there are a couple of pockets that do stand out. So we'll, of course, talk about that in greater detail. But the big pressure really is coming in, of course, from the Adani stocks. Adani Ports down 7%, but other banks as well are contributing on the downside. So the mid-cap index is down 400 points. The Bank Nifty is down almost 1,000 points. There was a brief attempt to recover, but that was sold into as well. So turning out to be quite an ugly day, ugly start at least for the markets. But let's see, the day is long. We also have a lot of big events coming up, right? I mean, there's the union budget next week. There's also the Fed policy next week. It's F&O expiry today. So a lot of cues to negotiate with. I guess you can safely say that this 18,200 mark continues to be a hurdle for the market.
It is, there is a weakness, a fair amount of weakness, but there are a lot of numbers which are, being reported as well. So we do have a management with us?
We do actually. So while we talk about markets, let's focus on individual names as well. Latent View Analytics posted a good set of Q3 numbers. Revenue is up 35%, while EBITDA margin is up 130 basis points at 29.5%. Rajan Sethuraman, who's the CEO at the company, is joining us now to discuss these numbers. Mr. Sethuraman, good afternoon. Thank you so much for joining us. Well, these are a good set of numbers that you've reported, but you did speak about sluggishness in two accounts. What category do they fall in? You have different categories, sub 5 crores, 5 to 10 crores, 10 to 50 crores. So which kind of client is that? And are you seeing this weakness continuing in the next quarter as well?
Right. Yeah, thank you for having me on the show. The sluggishness is mostly in the technology sector at this point in time. And this is because there is a certain amount of uncertainty, and you would have heard about the budget cuts and the layoffs, right, that they are experiencing. However, we are happy to share that all the renewals that we were intending to do in the quarter that just got concluded, that's all been completed. We didn't have any cutback in terms of the current contracted work that we have, and all of those contracts have been renewed for the next year as well. The sluggishness is a little bit on new initiatives and kicking that off. But having said that, there are also a bunch of larger opportunities through the RFP route, which are in play at this point in time. We're expecting that some of that will click and fall in place in the next couple of months, right, even before the end of this fiscal year. So there is sluggishness, but it's in the technology space, and we are seeing some interest in other sectors at this time.
Sluggishness in the new business is something that Satya Nadella spoke about Microsoft yesterday as well. So that puts you all in the same company. But, margins, the 9-month margins are closer to 29% This is much higher than your guided band of 25 to 28% Are there one-offs there, or are you looking to increase your margin guidance itself and aim for levels upwards of 29% going forward?
Not really. I mean, we will continue to stick with the 25 to 28% margin guidance. In fact, it's our constant endeavor that when we sense that the margins can be better due to one-off events or in general just operating performance, we would want to take it and plow it back into the business. So we are actually formulating the plan and the strategy for the next year as well as the next 3 years. And in the board meeting as well, there's fairly clear direction, right, that we should be ready to invest ahead of the curve, right, where required. So that's what we'll be doing.
Absolutely. I think that's the next big trigger, right? The investments that you're looking at. You're sitting on a cash of around 950 crores plus including the IPO balance. And in your press release, you've said that you're actively looking at new opportunities which will add to your capabilities. What are these new opportunities now, and where will this cash be put to use?
Right. So we are talking about two kinds of things. One is the organic capability building, and that is focused on sectors like BFSI and retail and CPG, and all the assets, accelerators, and value propositions that we intend to build, right, to support that. And then we have the inorganic action as well. Our inorganic strategy as well is aligned with the sectors and the horizontals that we intend to focus on from an organic standpoint. So right now there are about 3-4 opportunities on the table where we are at round 2 or round 3 of discussions. I don't expect that it will close in this quarter, but we should have some action right in this quarter and next quarter and get closer to signing something.
Okay.
And this is a spectrum of opportunities ranging all the way from $4 million in revenue to about $15 million in revenue. So we will see how this pans out in the next 1-2 quarters.
Okay, so you do have spectrum of opportunities. You are at various stages of closing some deals as well. But just on the other side, because you have mentioned that there is a slight delay in decision-making process for new initiatives, but of course, at the same time, you're not seeing any budget cuts for now. Do you think that is something which will slow down deal wins in 2023, or will it be similar to the levels that we saw in 2022?
I think my own personal take on the current situation is that data analytics is going to be key to resolve the uncertainty and the budget constraints that organizations might be facing, because many of the data analytics initiatives are fairly core and central to drive P&L impact, whether it is on revenue growth or margin enhancement. So the conversations that we are currently having, the large opportunities that I mentioned, right? These are either mature organizations that are looking at, okay, we can do a lot more with data analytics through consolidation, driving more complex initiatives. And then we also have first movers into the data analytics space. First, or they're starting off with their data analytics journey for the first time, but they see this as an opportunity to leapfrog and set up some capability centers, right, in a location like India that can give them the kind of competitive advantage that they are looking for. So action across the spectrum. My expectation is that this will pick up in the coming quarters. So while there will be uncertainty, there will be organizations, both mature and otherwise, who will start looking at data analytics as a fairly important way by which they address even the uncertainty that might be there in the economy.
So should we assume that this 10 to 11% sort of quarter-on-quarter growth that you've been reporting in your revenues over the last couple of quarters will sustain and accelerate, or is there any downside risk to that?
So on the medium term, I believe that we can sustain that kind of stuff. But obviously, in the short term, I did mention the sluggishness right when we started off, and decision making is getting delayed a little bit. So we'll have to see how quickly these large initiatives will fall in place. Out of the 5 big opportunities that we are chasing, even if we land 1 or 2, it can be a pretty big kicker for us. So I'm reasonably optimistic at this point.
Okay, all the best. Thanks a lot for joining in, and all the best for the future. That's Latent View Analytics. By the way, I just want to pull up the chart of Bajaj Auto. That stock is at the highest point of trade right now. It comes out with its numbers in just about an hour or two. And ahead of the earnings, Bajaj Auto is, bucking the market trend as well as going into its numbers quite strong. When we come back from the break, we'll connect with Kamlesh Shah, the CFO of Elecon Engineering, to discuss their Q3 earnings. Stay tuned. Welcome back to Halftime Report. Well, we're talking about a lot of companies that have reported their numbers, and industrial gear and material handling equipment major Elecon Engineering posted quite a strong set of numbers actually. The revenues for this quarter are up 43%. EBITDA is up by 71%. And, if you look at the 9 months figures as well, it's been a pretty solid performance that Elecon has seen. 26% growth in the 9 months at 1,100 crores. Kamlesh Shah, the CFO of Elecon Engineering, joins in. Mr. Shah, good afternoon and thanks for joining us. Tell us, you sitting on a base of around 1,100 crores 9 months of this year. What will you do by the end of the year, by the end of FY23? And you have a guidance of 2,000 crores revenues by FY24. Are you on track to achieve that?
Yeah, good morning. Thank you. As we already discussed earlier also, we are quite confident about this current year number. On consolidation, we are expecting 1,500 crore, and we are confident that we will achieve that. And next year guidance, we are sustaining 2,000 crore for FY24 on consolidation.
And what's the order inflow been in the second half of this year? You had a target of 750 crores coming in. Do you want to change that? And at the same time, margins, by the end of this year, you were targeting about 22%. The first 9 months, you have done about 22.3%. That sustains as well, is it?
Yeah, that will sustain because marginal changes on account of product mix. But at the end of the year, we will be at least definitely at 22%. on a consolidation, my EBITDA margin.
Okay, 22% margins. Can you give us a sense of how the export markets are doing? Because you did expect a lot of orders to come in after Christmas. How was it in quarter 3? What was the breakup? And how is it panning out right now? Because a lot of companies have spoken about a weakness in export markets. How is it doing for you?
Yeah, it may be, but we have put our strategy right, and we are just working. Our thrust is more on exports and overseas business, and we are putting all our thrust on that, and we are combining, consolidating all our overseas operations, and we are putting the strategy right. We are having our international conference somewhere in February at Doha, where we are going to discuss about the next line of strategy for next 3 years. And
Mr.
we are
Shah, I think my colleague's question was more to do with, are you seeing any slowdown in any of your export markets?
No.
Any delays in decision making by clients?
In fact, we are thinking that that's an opportunity for us, and we have to grab that opportunity in the European market.
Right.
And we are putting more thrust on the OEM markets. That is where our strategy is.
You didn't speak about the order inflow. I mean, what's the current order book that you're sitting on? What's the kind of inflow that you're expecting? Because 2,000 crores next year in terms of revenue would mean a 33% jump over this year's guidance that you have. What gives you this optimism?
Yeah, it's because it's realistic for us. The only thing, external factors like COVID and that kind of unforeseen circumstances, if there's anything previous, maybe related to war, it may have the impact. Otherwise, on a normalcy, that my target of
Mr.
2,000
Shah,
crores.
yes, we do get to your point that yes, even export markets are doing well. But the order inflow is a number that the investors would like to know as well. So what has the order inflow been till now? What kind of orders are in the pipeline? So by the end of this year, what kind of order book are you expecting? And which sectors is this demand coming from?
My open order position as of 31st December is to a 720 crore on console level. And we are having some kind of orders. We are at least working very hard for some OEM also on the overseas market. And once it will get material, it may go on a ramp up basis, not immediately will get, but I think we are working very hard and we are right on our strategy.
I didn't what was the order book you said?
As of 31st December, my open order is 720 crore.
720 crores, okay, that's the open order book. Can you tell us within the defense vertical, what is the kind of orders that you've got up until now and any order visibility from defense?
My team is working, but presently we can't say what the order we are going to expect in the next year or maybe in the coming period also. But presently, my order from the defense sectors is nearly 130 crore.
And your material handling business, I mean, that has relatively lower margins as compared to the overall business. Material handling has margins of 14% as against the overall margins of about 22%. What's the plan of improving margins there, and what kind of run rate can this business go at going forward?
We are not very aggressive on material handling considering the current situations in the market in India. We are focusing mainly on the supply part and the after sales services, and we'll continue the same in the next year only in 23-24.
Okay. So you're talking about defense order book being around 140 crore rupees. Can you tell us what is the high margin segment for you? Is it defense, is it steel, power, or do you work on same margin profile across all the segments?
No, it is not so, because our catalog product, generally what we understand as a standard product, will have the one margin, which is standard in nature. Whereas the engineer product, which we understand as a customized product, is having that better margin, because there we are putting the designing part also. We are giving the complete solutions to the customers, and that is also very high value in order also.
Okay, all right. We'll let you go on that note. Thanks for joining us, Mr. Shah, and giving us an update on the business. That's Elecon Engineering. Good numbers coming through, and they're quite optimistic going forward as well. Let's slip into a quick break. On the other side, we'll get you a conversation with Bharat Puri of Pidilite. It's one of the big losers today after the Q3 earnings disappointed. More on that coming up.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Well, overall markets are under a lot of pressure, and Adani Group stocks, they are falling in trade today after Reuters highlights details from a Hindenburg research report on the group. Hindenburg says that they hold short positions in India's Adani Group via US traded bonds and via non-Indian traded derivative instruments as well. Reuters says Hindenburg expresses concerns over valuation, says over 7 listed companies of Adani Group have 85% downside on sky-high valuation. Hindenburg also says Adani companies have taken on substantial debt against shares, placing it in a precarious financial position. Reuters says the Adani spokesperson did not immediately respond to a request for a comment on the Hindenburg research report.
Okay, well, let's slip into a quick break on that note. The market is still under quite a bit of pressure, down about 229 points, no recovery at all. On the other side, as promised, we'll get you a conversation with Bharat Puri of Pidilite on their Q3 numbers. Well, amidst all the chaos in the market, one sector that's doing quite well is the auto space. Just wanted to point out a couple of charts for you. Mahindra CIE is one stock that's really charging away. In fact, the stock is up 50% in the last 6 months alone. And ever since the board of Mahindra CIE expressed its intent to sell off the company's less profitable European business truck forging arm, that's when the stock started to rally. So that's one of them. CEAT comes out with its numbers later in the afternoon. CEAT is also surging, expected to be a good set of numbers because the raw material basket has cooled off quite a bit, both crude and rubber prices. So CEAT is the other stock that's at the high point right now, I think. Sona BLW, we had a chat with the management, a very positive commentary. 25 to 30% revenue growth is what they're looking at in FY24, and big opportunities in the electric vehicle space. And TVS Motor, of course, from the frontliners has been a big mover on the back of strong management guidance. But as promised, let's get you the opinion from Pidilite. It reported a weak Q3 on the back of a high base. Profits after tax was down 14%. Margins have contracted as well. Earlier, in fact, Mangalam caught up with Bharat Puri, the MD of Pidilite, began by asking him about how the quarter was and how they see growth going ahead. Listen in.
See, my invitation to you is firstly a simple direct answer to your question. No, actually for us, Q3 has been as per expectations. And I'll tell you why. Last year, as we've said also in our press release, Q3 was a big quarter for us because we've taken very significant pricing actually twice in the quarter, once in the beginning of November and once on the 1st of Jan. As a result of which, obviously, the trade had stocked up highly, inventory in trade had gone up substantially, and we had had a very good quarter. In fact, if I recall, we had grown by about 25%. Now, in that context, when we were planning, obviously, if you remember last year at the end of Q4, you were asking me, is Q4 a little depressed? And at that time, I told you, please look at Q3 plus Q4. My simple invitation to you would this time also would be look at Q3 plus Q4, because obviously this time we have not had that kind of inventory build up. Simply because obviously there is, right now prices are stable and therefore there is no need for the trade to stock up. The other thing I would draw your attention to is two things. One is if I look at my CAGRs, even over these high bases, over a 3-year period, we have very healthy value and volume CAGRs. If I look at the 9 months, we're growing at about 23, 24%. Or again, volumes are extremely healthy. So to my mind, this quarter, and obviously you're always going to have quarters where you're going to have at times depressed primary sales. But when I look at our secondary sales, frankly, it's as per expectation. I mean, if I was to tell you what is the only headwind, I would still say that rural and semi-urban demand is still strained. We are still to see the recovery in rural and semi-urban. But here also, I must add that as far as we're concerned, unlike, say, FMCG, we're not declining or constant in rural. Our growth rates, which used to traditionally be 1.5 times urban, are now near about urban or actually a little lower than urban. And that's the matter of concern. We believe, slowly that is now bottoming out, and starting Jan, hopefully we will see better rural and semi-urban demand. But at an overall level, frankly, as we've said in our price increase, we say we're increasingly optimistic. And you always ask me, why do you say cautiously optimistic? So this time we're increasingly optimistic. And that's really because of two big things. One is from a raw material situation, we're very comfortable. We've seen through most of our high-priced inventory, VAM remains now at about $1,200 a ton against $2,500 a ton a year ago. We're also seeing good construction activity, good demand conditions, especially in urban India and T1, T2, Tier 3 towns. That continues. And therefore, if with the return of rural and semi-urban, I think we will be really in a good shape. So that's why we're saying we're increasingly optimistic, because internally we believe the worst of raw materials is behind us. We will slowly return to our normal margin range. And we remain optimistic on demand also in rural and semi-urban coming back. We don't have any complaints about urban demand as of now.
Would you say it's been a little longer than you expected for your margins to come back to normal levels? I mean, currently, if I look at it, 16.5% is still way below the 20-24% band that you have. And earlier when we spoke, you said that 20-24%, which is the normalized band that you have on an annual basis, will come by from the fourth quarter. Should we still believe that's on the cards? And is all the high price inventory out of the system? Is all the inventory at the dealers end out of the system now?
See, a large part of the high-priced inventory has been consumed. There will be still some that will get consumed in quarter one. Exit March, you will definitely see us in the range that we've always indicated. That appears quite imminent. Barring no other black swan events, no other oil price shocks, Russia, Ukraine's, COVIDs, etc. Frankly, I think the first quarter of the next year will see us in our traditional margin range. Our focus, therefore, has to be on positive volume growth. And to answer your question, yes, I mean, this has probably been the perfect storm from a raw material perspective over the last 24 to 30 months, pretty much for the world, but especially for us, because, I mean, if you look at our gross margin vis-a-vis 2 years ago, it's not a decrease of 100, 200, 400 basis points. We're talking of 800 to 1200, 8 to 12% of sales. And that's been unnatural. And obviously, we haven't passed all of it on. The good thing is we're now pretty much seeing light at the end of the tunnel. We're now buying in raw materials, what we believe are the correct prices. We believe our decision to take pricing only at 75% of inflation was the correct decision, because inflation has moderated, and therefore we don't even have to do a fair amount of price reduction because we didn't take price up that much. And therefore, we look forward to the future with increased optimism.
All right. You've replaced cautious optimism with increased optimism, and you've spoken about that as well. Can you quantify the difference between cautious optimism and increased optimism?
See, cautious optimism there was optimism on the demand front and beginning to see raw material moderation. Increased optimism is demand remains robust in urban. We believe rural and semi-urban, with the kind of steps that are being taken, the crop, the monsoon, the money that is going to come in, will also start turning up. And raw materials, now it's real. The material that I'm consuming in January and February is at the right prices, and therefore increased optimism. Now it's not something that will happen in the future. It'll start happening from this quarter itself.
All right, and final question then. Word on the street is that you are also tempted to enter the paint space in where everyone is excited about right now. I mean, you are 2 times the reach of the largest paint dealer. So, I mean, that should allow you to, use your brand, use your capex, etc., and your own Asian Paints experience from the past to look at this space. Is that correct?
We've always, we keep getting asked this question. Pidilite has always overlapped a fair bit with paints for a number of years. There are a lot of waterproofing products, waterproofing cum paint. For example, Dr. Fixit, the raincoat product for the exteriors, obviously competes against the paint company exterior products. This one has waterproofing and beauty. Most paint company products have only beauty. So we're no strangers to paint, but are we looking at some full-fledged, 4-plant, new 4 plants, big entry into paint? The answer is no. We've always said Pidilite is a disruptor. Pidilite is a pioneer. When we find ways of pioneering the market, those are segments we enter. And if you look at the number of pioneer categories, be it tile adhesives, be it tile grouts, be it exterior renders, be it flooring, we've got a whole retinue of stuff. In the next 12 months, Mangalam, you will see Pidilite launch 1 big and 3 small innovations in pretty much most of our divisions every 3 months.
All right. And Q4 is double-digit volume growth, right?
Right. Our obvious, this thing is, we've always said our core category should grow at 1 to 1.5 times GDP, growth at 2 to 4 times GDP, and Pioneer should become growth quickly. So yes, the moniker for us is high single digit, or for my internal teams, it is definitely double-digit volume growth.
Okay, so for the teams, they're looking at double-digit volume growth for the company. Well, that's an important interview. But now it's time for the CNBC TV18 budget quiz. Remember, there are prizes to be won every day. We gave you the question at 9:14 today, but in case you missed it, here it is. When did Nirmala Sitharaman present her first budget? Your options are A, Feb 1st, 2018, 2019, July 5th, 2019 or Feb 1st, 2020? Send us your answers on Twitter. You can post your answer as a comment on the question, tweet on CNBC TV 18 News. Use the hashtag budget with CNBC TV 18. Hurry and send us your answers. Remember, we'll announce the winner at 3 p.m. today.
Welcome back. You're watching us here on Halftime Report. Weakness continues for the market, but let's talk about the special now. We've been talking about how CNBC TV 18 has compiled a list of all the top 20 stocks to watch for in this year. It's a carefully curated list of the companies that want a closer look in 2023. So to start off that series, among the first few stocks that we have today, Sonal is standing by at the big wall. What's the stock on your radar, Sonal?
Thanks a lot for that, and that's right. Today on my radar is a stock from the oil and gas space. The stock we are watching out for 2023 is the energy major ONGC. Now, three things that define the earnings for this company: crude prices, gas prices, and production levels, among other things. So why exactly are we looking at ONGC this year? The outlook on Brent prices is at $90 per barrel for 2023, and China is reopening, which is expected to increase demand, and it will push prices as well higher. Kirit Parikh Committee's recommendations on gas pricing are positive for ONGC. The Mozambique project, which may see progress in 2023, and output from Sakhalin-1 is expected to normalize as well. So let's discuss these in greater details. First is oil realizations. Crude prices are expected to be higher, and net realization for ONGC may stay above that $75 per barrel mark despite windfall taxes. The question really remains is whether the government will ensure realizations at current levels. So far, the windfall tax levy indicates that yes, it is possible. Stock price implies a $45 to $50 per barrel realization, which is way below current realizations and is positive. At $75 per barrel, average realizations are higher than that between FY15 to FY22. Now on to gas prices. One of the highest levels that we've seen since APM gas pricing has been introduced. In fact, there was a fear that this has been very volatile and there could be some taxes here as well. But now Kirit Parikh Committee has put out some recommendations for gas pricing, which included valuing domestic APM gas prices to 10% of Brent prices, putting a floor to domestic gas prices at $4 per MMBTU, and also proposed 20% premium over prevailing gas prices to incentivize production from age-old nominated fields. This, if approved, will be very positive for ONGC, as company's cost of gas production is $3.50 per MMBTU. Now on to production levels. The Mozambique project, which was delayed, where ONGC has 16% stake, may see further progress in calendar year 2023. And Sakhalin-1 field, where Exxon declared force majeure due to Russian war and where returns come via equity oil for ONGC for its 20% stake, is expected to see normalized production by March 2023 as well. The other thing that works for ONGC is the dividend payout policy. Their dividend payout has been between 30 to 60% in last few years. That definitely is positive for investors. Now, what are the possible risks? Production levels. Oil production from domestic fields is down now to around 19.5 million tons in FY22 from 26.5 in FY 2005. And gas production from domestic fields is down to 20.6 billion cubic meter from 24.7 that we saw in FY19. And ICICI Security remains conservative on production growth estimates as well. Other risks include delay in start of production from KG-D6 basin, decline in oil prices, higher windfall taxes, and no action on Kirit Parikh Committee's recommendations. Stock has valuation support, trades at 2.7 times FY24 EPS and 0.5 times price to book value. And leaving you now with the brokerage recommendations as well, the likes of CLSA, Goldman Sachs, HSBC, they have buy rating, and the ones like Kotak City, they have a sell rating, and other names are also there on the screen for you to see.
Okay, as a standard disclaimer, this is of course not a stock recommendation. The CNBC TV 18 editorial team does not advise on trading or investing in the stock market. You can take your own decisions as per your investment advisor. Any investor or viewer is advised to carry out necessary diligence on their own or through a certified registered financial planner for investment decisions. Let's take a quick break on that note. On the other side, Manisha Gupta joins in. She has with her Rahul Sharma, the Director, India International Zinc Association. Stay tuned.
Welcome back, and joining us on the show now is Rahul Sharma. He's Director, India International Zinc Association. Rahul, hi, good to have you. And what a start to 2023 for across the sector, which is base metals, and the zinc prices also are up nearly 12 to 14% in the month of Jan already. What do you give to that, and are you looking at this price gain sustain?
Good afternoon. Market optimism on improving demand following China's reopening amid global supply constraint has definitely boosted zinc prices, over the past month. China is the world's largest zinc producer and consumer. The country's zero COVID policy over the past 3 years has significantly reduced industrial activity and zinc demand. The easing of China's zero COVID policy is expected to spur the country's economic activity and boost zinc demand. The current LME price is approximately USD 3435 a metric ton this morning. So that was like 5% up from a month ago. Being a global commodity, geopolitical situations play a key role in maintaining a smooth demand and supply for zinc. Zinc prices have been rising since early November, when China first indicated that it would ease its strict COVID policy. Market hopes of improving demand amid reduced production in Europe due to high energy costs have boosted the zinc market over the past 2 months.
Absolutely.
So
But Rahul, when
that
you look at the inventories, I mean, that has played a big part as well. In the last year, we've seen zinc inventories decline by 85% on LME warehouses. And, various reports suggesting that there is zinc availability barely for a day of global consumption. I mean, these numbers sometimes are blown out of proportion. But what's your sense on the inventory part of it?
Well, following the decline in 2022, the International Lead Zinc Study Group, they have forecasted that global refined zinc production will be increased by 2.6% to almost 3.84 million tons in 2023. So zinc production in China is expected to grow by 3.8% in current year, and following the ease in COVID restrictions. Then rising output is also forecast in Australia, India, Kazakhstan, Mexico, and Turkey, where a new smelter is recently been commissioned. World demand for zinc is expected to rise by 1.5% year on year to approximately 14 million tons in 2023. Usage in zinc is expected to grow by 3.8% this year, and 1.2% will be next year. That's the prediction. Consumption is also anticipated to rise in developing economies like India, Indonesia, Thailand, Mexico, and other developed economies like Japan and South Korea. Demand is projected to be flat or just positive in Europe and in the US.
Okay.
I think as geopolitical tensions reduce and global economy situation improves, you can see an increase in supply and demand of zinc worldwide.
All right. So how different is zinc as an industry is going to be from what we saw in 2022? As you said, the supplies are increasing and so is the demand growth in that sense. What is the kind of deficit of or an excess that we are looking at? And what is the kind of price move that you're expecting?
Well, this will be a very interesting time. The zinc market has been volatile over the past year, and the LME price hitting a new all-time high of 4,896 ton on March last year and then dipping sharply. I observed that because of uncertainties like China COVID restrictions, manufacturers in those countries were keeping bare minimum stocks and were utilizing their reserve inventories for manufacturing.
Right.
This in turn hit the demand and affect supply chain, which was reflected in drop in LME prices. Now, zinc metal demand outlook seems to be positive as economic activities are coming back to normalcy. However, few experts are skeptical about uncertainties which might hit the demand in short term. Having said that, I foresee that now current LME prices are indicating that demand has returned back and manufacturing activities in various countries, including China, has increased after ease of COVID restrictions. So overall, I can say that zinc market seems to be promising in long run.
Okay. I know, Rahul, you normally do not talk about the price view going forward, but I mean, as you said, there is supply coming back, and we did see big shutdowns in Netherlands, France, Germany in the last year. The zinc inventories decline is because of that as well. But mining disruptions, declining capital expenditures are some of the factors which really do seem to be bothering the industry.
I think still, the winter is going on in Europe and there is a high energy cost. And because of that, you are quite aware that the smelters of Nyrstar and Glencore, they have either reduced the production or they have to shut down. But going forward, as zinc metal demand is soaring because of increased economic activities across globe, we will see an interesting time. However, any changes in geopolitical situation can affect this like any other commodities. I anticipate that prices may further go up as manufacturers will first replenish their reserve stocks in their backyard and further purchase to meet the added demand of the market. To me, level of USD 3,500 in short term can be breezed, but current LME prices indicates that demand and supply are very near to a state of equilibrium.
All right.
All right. Thanks a lot for joining in and giving us those views on the commodities arena. For the market, however, we've seen a wee bit of recovery from the low, still holding with cuts of almost 200 points on the Nifty. We've seen some recovery coming in from the 100-day moving average on the Nifty, which is, or rather, we're closing in on that 100-day moving average on the Nifty, which is at 17,950 odd. With that, we're out of time on this edition of Halftime Report. Business Lunch comes up ahead. Thank you for watching.